Are you one market crash away from delaying retirement? It's an uncomfortable question, but for many investors, it's a real one. If a significant downturn would force you to reconsider your retirement date, reduce spending, or return to work, then your plan may be more fragile than you would like. Today, we're going to talk about retirement income stability, sequence of return risk, diversification beyond public markets, and how self-directed accounts work within IRS guidelines. Welcome back. Today, we're going deep on an underappreciated retirement topic that doesn't get nearly the attention it deserves. We're talking about sequence of returns risk. Now, if you've never heard that term before, don't worry. By the end of this video, you're going to understand it completely. And more importantly, you're going to understand why it matters for how you think about structuring your retirement strategy. So here's a quick preview of what we're covering today. First, what sequence of returns risk actually is, with a simple example that makes it crystal clear. Second, why traditional portfolio structures can make this problem worse. Third, how a self-directed IRA expands your options when it comes to diversifying across different asset classes. And fourth, some practical things to think about as you start exploring whether a self-directed IRA might make sense for your situation. Quick note before we dive in, Mountain West IRA is a self-directed IRA administrator. We are not financial advisors. Nothing in this video is financial advice. Please work with your own qualified advisors for guidance specific to your situation. We're here to educate. That's it. Okay, let's get into it. Let's start with the core concept. Sequence of returns risk is the risk that the timing of market gains and losses, specifically the order in which they happen, can dramatically affect how long your retirement savings last. And here's why this is so counterintuitive. Two portfolios with the exact same average performance over 20 years can produce completely different outcomes. One person runs out of money, the other doesn't. Let me tell you why. Imagine two people retire with the same amount of savings. Over 20 years, they both experience the same overall average performance. But the sequence is reversed. Person A has strong gains in the early years of retirement, then weaker performance later. Person B has weak performance, a significant decline in the early years, then recovers later. Here's what happens. Person B, who experiences the decline early, was withdrawing money every month during that decline. They had to sell more assets at lower prices to fund their living expenses. Those assets are gone. They can't participate in the recovery. By the time markets recover for person B, there are fewer assets left to recover. The damage from those early years is permanent. Now, person A had gains early, which meant their portfolio grew even as they withdrew. When the weaker years came, they had more to work with. Same average, completely different outcomes. This is the sequence of returns problem, and it's entirely about timing. Now, here's where this gets really interesting from a structural standpoint. Traditional portfolios can amplify the problem. Traditional retirement portfolios built primarily from publicly traded stocks, bonds, and mutual funds have a characteristic that can make sequence of returns risk worse: correlation. When the stock market drops significantly, most publicly traded assets tend to drop together. They respond to the same economic forces: interest rate decisions, corporate earning cycles, geopolitical events. So, if your portfolio is highly concentrated in publicly traded securities, a major market event can hit most of your holdings simultaneously. And that's exactly the scenario that creates the worst sequence of return outcomes, because you're withdrawing while nearly everything is down at once. Now, I want to be really careful here. I'm not saying that publicly traded securities are bad. I'm saying that a portfolio exclusively composed of them has concentrated exposure to certain risks. And sequence of return risk, particularly the compounding effect of withdrawals during a downturn, is one of them. This is one of the reasons why the concept of diversification across different types of assets, not just different stocks, has become such an important topic in retirement planning discussions. So, let's talk about self-directed IRAs. A self-directed IRA is a retirement account structure, same IRS rules, same tax treatment as a traditional brokerage IRA, but administered by a specialized custodian and administrator that can hold a much broader range of assets. While a standard brokerage IRA limits you to publicly traded stocks, bonds, and mutual funds, a self-directed IRA can hold alternative assets like real estate, residential, commercial, raw land, rental properties, promissory notes, where your IRA acts as the lender and earns interest income. Private placements, those are interests in private funds or companies. Private stock, equity in non-publicly traded businesses. Precious metals, kind of popular right now. Physical gold, silver, platinum, and palladium are stored at an approved depository. And cryptocurrency, digital assets like Bitcoin and Ethereum, and so much more. Now, here's the key point in the context of sequence of returns risk. Each of these asset classes responds to different economic forces than publicly traded stocks. Real estate values are driven by local supply and demand. Promissory notes generate income based on loan terms. Precious metals respond to inflation expectations and global demand. Private companies are valued on their own fundamentals, not daily trading activity. This is called low correlation. And for someone thinking about how to build a retirement portfolio that's more resilient during the downturn phase, low correlation matters. When your assets don't all move in the same direction at the same time, you have more options for what to draw from during different market environments. So, let's spend a few minutes on each of these asset classes so you understand what you're actually looking at. Real estate. Real estate inside a self-directed IRA can be incredibly versatile. Your IRA can own rental properties, commercial buildings, raw land, or even real estate notes. The important rules: the property cannot be for your personal use. That's a prohibited transaction. All expenses must be paid from the IRA. All income must flow back into the IRA. This preserves the tax advantage status of the account. But Within those rules, real estate can be a meaningful diversification option. Rental income can provide steady cash flow during the retirement drawdown phase. Local real estate markets don't necessarily move in lockstep with stock markets. And of course, people always need a place to live and a place to work. Promissory notes. A promissory note is essentially a loan made by your IRA. Your IRA is the bank. Your IRA is the lender. The borrower could be an individual, a company, or another entity. The borrower pays back the principal plus interest according to the terms of the note. Why does this matter for sequence of returns risk? Because a promissory note generates income based on the terms of the loan agreement, not on stock market conditions. The income is determined when the note is created. That predictability can be valuable during a downturn phase. Of course, there's borrower risk. What if the borrower doesn't repay? That's why due diligence is entirely your responsibility as the account holder. We can't advise you on specific notes. That's your job, ideally with the help of a qualified advisor. And of course, you always have the ability to secure that note with an actual asset. If you're lending to a real estate investor, you can secure it with that real estate. Okay, precious metals. Gold, silver, platinum, palladium, all of those can be held inside a self-directed IRA in approved physical form. The metals must be stored at an IRS-approved depository. You can't take personal possession of them while they're in the IRA. Precious metals have historically behaved differently from equities during certain market environments. They're not a perfect hedge against anything, but they're another asset class with a different correlation profile. Private placements and private stock, kind of close together. Private companies, those not listed on public stock exchanges, can be held inside a self-directed IRA. This includes interests in private funds, private placements, and equity in specific private companies. Because private company valuations aren't determined by daily public trading activity, they can behave really differently from publicly traded securities. They also require substantial due diligence. There's no public market to rely on. So understanding the business and the terms of your agreement is critical. Digital assets, cryptocurrency, digital assets like Bitcoin and Ethereum and all the rest of those coins can be held inside a self-directed IRA. Cryptocurrency has its own volatility profile. It's not for everyone, but for those with knowledge and conviction in digital assets, being able to hold them inside a tax-advantaged retirement account while maintaining some diversification from traditional markets is a meaningful option. Okay, moving on. Practical framework. So how do you actually think about using a self-directed IRA in the context of sequence of returns risk? Here's a framework. Now, this is not advice, just a way of thinking. Step 1, know your timeline. The sequence of returns problem is most acute in the 5 years before and the 5 to 10 years after retirement. Where are you in that window? Step 2, audit your correlation. If all or nearly all of your retirement savings are in publicly traded securities, you have a highly correlated exposure to stock market movements. Is that intentional? You need to check into that. Step 3, identify what you know. A self-directed IRA is most powerful when you direct it towards assets you genuinely understand. Real estate professionals, business owners, people with deep knowledge in specific areas. The control is most valuable when it's paired with your expertise. Step 4, understand the administrator's role. Mountain West IRA holds your assets and processes transactions at your direction. We're not financial advisors. We don't make recommendations. You direct, we administer. Step 5, work with your advisors. I cannot say this strongly enough. A self-directed IRA is a powerful tool, and that means the decisions carry real weight. Work with a qualified financial planner, tax professional, or attorney before making decisions about your retirement strategy. Now, if today's video helped you understand sequence of returns risk and how a self-directed IRA can expand your options, I'd love for you to take one next step. Visit mountainwestira.com. Read through our educational resources. Call us with any questions at 866-377-3311 or leave a comment below with your questions. We read them all. If you like, you can also set up a time that works best for you for us to have a conversation and answer your questions by using the QR code in the corner, and then go have an informed conversation with your advisors about whether this is something worth exploring in your exact situation. We're not going to tell you what to do with your retirement savings, but we are going to make sure you understand what's possible. Thanks for watching, and we'll see you next time. Bye.